How's everybody doing today? Thank you for joining us for today's training here. Let me go ahead and share my screen a minute so I can share today's presentation with all of you. All right, so today's training, one that is very dear to my heart, mastering pre-approvals for loan officers. Hold up a second. I think we're trying to share the screen here a minute. All right. Mastering pre-approvals for loan officers. So let's wait for a few more people to log on. This is a great training, one that we get a lot of questions on, one that is essential to your success in your career as a mortgage loan officer, in building credibility with borrowers, as well as building credibility with your referral partners, which are typically the realtors, or which are our biggest referral source, as well as prior customers and other people that are in the biz. But we know that the best referral partners to have that always are going to be sending you business if they see you as the consummate professional are real estate agents, right? And this is what you're going to learn in today's training is going to be information that you're definitely going to be able to convey to your borrowers as well as your referral partners, because you want everybody to know that you go above and beyond when you're providing a pre-approval. You're definitely going to dot all your I's, cross all your T's, and make sure that you are providing a solid and thorough pre-approval, right? So let's give it another minute for a few more people to log on. As I see, there's still people logging on. But one thing that I want to make note here is, remember, a pre-approval is not a pre-qualification. We should never really offer a pre-qualification as any sort of means by which a buyer can actually purchase or close on a loan, assuming it's a refinance and not a purchase loan. So let's get right into it. Mastering pre-approvals for loan officers. So what exactly is a pre-approval? Well, a pre-approval is a preliminary evaluation of a potential borrower to determine for which program options they qualify. Now, like I was alluding to a minute ago, a pre-approval is not a pre-qualification. And by the way, a pre-qualification is not a pre-approval, right? A pre-approval is a true credit and income approval, right? In providing a true pre-approval, you're going to be shining as a loan consultant, right? You're not an application taker, right? And this is going to allow you to build credibility and gain the trust of your borrowers and your referral partners. They're going to definitely appreciate that you're going the extra step in providing a true pre-approval and not a pre-qualification. A pre-qualification is somebody calls you, you're on the phone, you're asking them basic questions, and you're telling them, yeah, based on the information you've provided, this is what you could do. Now let's get into the pre-approval. Now, what I would consider the pre-qualification is when you're on the phone with the borrower, and I like to call it your sizing of the deal, right? You're going to speak with your borrower about their credit. Now, we have a separate training on mastering the initial call from the borrower to make sure that you gather as much information as possible so that you can send your borrower viable quote options, and then your borrower can apply, and then you can process the application to provide a pre-approval, which would be then the next step would be disclosing the file, assuming you got them pre-approved. Now, if it's TBD, right, you're not going to disclose a file until they have a property. That's what they want the pre-approval for. If it's a refinance, it's going to be one process, right? They're going to apply, and then you're going to, disclose the loan and submit the loan for underwriting, assuming everything is as it should. But when you're having that initial pre-qualification phone call, as I like to call it, you're going to be discussing credit. You're going to obtain as much credit information from the borrower as possible. If they start telling you what their credit scores are, you're going to ask them where they obtained the information, maybe find out if they have Credit Karma and the Experian app. Possibly they could share snippets of their scores, or maybe the account balances that they have, so that you can discuss the balances and how the balances could affect their credit scores, and how the credit scores could improve if the balances are brought down. That's another training that we have on evaluating the credit report and doing a rapid rescore, right? So these you definitely want to get as much credit information. It's not just like, what's your credit score? 720? Okay, and proceed to the next set of questions. You're going to want to delve deep into credit. Ask them questions like about credit events, collections, charge-offs, foreclosures, short sales. Are there any accounts that you're co-signing for that somebody else is making the payment? What are the minimum payments on your credit cards? Do you have any car loans? What's the payment on those? Do you have any student loans? Are the payments deferred? What's the balances? I mean, you don't want to be surprised with any of this information when the credit report comes back at a 510 when they told you it was 680. Because if you ask them all these questions and the customer provides the answers, you're going to have a pretty good idea of where their credit is and what can be done to make it better. Like if they're telling you the balances are 7,000 on their credit cards and the limit is 8,000, you're going to know now that if they bring those balances down, that could improve their credit. Remember that you want them to work with you. If they view you as a consummate professional, that's what's going to happen. You don't want to be an application taker and be on that call for 1 or 2 minutes and then send them some quotes that you think are, going to hit the mark, and then have the customer apply, get the credit report, and find out again that the score is a 510 when they represented to you was a 650 or 660 or 700. That's why you want to ask as much information as possible and see what they can share with you from portals out there that are free, that provide information to them, like Credit Karma and the Experian app and some of these other apps out there that allow borrowers to check their credit score. Now, keep in mind, residential mortgage credit reports use the FICO 2 and not the FICO 8, which is what a lot of these applications use. The FICO 8 is geared more towards credit cards, whereas the FICO 2 is more towards residential mortgage lending. So those apps aren't going to be accurate. Sometimes they're higher, sometimes they're lower. I had a customer that had a 640 middle score on Credit Karma, but the residential mortgage credit report actually came in at a 700. It's a different scoring model. Most of the time it's the opposite though. Most of the time it tells you 680, 690, and then it comes in 10, 20, 30 points lower. But at least it gives you an idea, and at least you can also, if they can share the balances on the cards and the limits on the cards, you can have an idea of where the credit is going to be and what you can discuss with the borrower. So you definitely want to talk about credit. You want to talk about income, right? Remember, this is all part of the pre-qualification call, so that then you can send them viable options for quotes, and then you can start the process on the right trajectory. So talk about income, if they're self-employed, if they're salaried, if they're hourly, tips, bonuses, all that kind of good stuff that you want to find out about their income. If it's an investment property, especially important. If they're self-employed, also important, like I mentioned, because then you have more options that you can discuss with them. Then you want to discuss their assets. If it's a purchase, are there any gifts coming? Is the money already in the bank? Was it recently deposited? Is it can you source the large deposits, stuff like that, or is it going to have to wait till the money is seasoned in the bank? And then the last would be the property, right? If it's a refi, you definitely want to talk about property condition. You don't want to be surprised with an appraiser going out to a property and emailing you and letting you know that it's missing kitchen cabinets in the bathrooms. That would require a renovation loan as opposed to a regular transaction. So again, get as much information on the initial pre-qualification call, but remember, you do not want to issue a pre-qualification letter nor issue a pre-approval letter based on your pre-qualification call. That is not acceptable. Even if the borrower tells you, I got a 760 credit score and I'm putting 20% down, because how many times have we had them say that and then they don't have the money in the bank, or who knows where it's coming from, and the score is not a 760 but a 630, right? And you've issued a pre-approval letter based on the information the borrower provided. Now they get on the contract, and now when you actually get the credit and get the docs that you would have obtained for the pre-approval, everything changes. What's going to happen with the credibility that you're going to have with your referral partner, the realtor, and with the borrower, who's going to say, man, I put $10,000 on deposit. I thought I was going to do a 3% down loan, and now you're telling me I got to give 10, 15% down. My interest rate's not going to be 6.5. It's going to be 9.5. And now I don't qualify because I don't have the money and my income is too low for the program that I actually am pre-approved for. So unless you want to be in that boat, do not ever issue a pre-approval letter based on information provided to you that hasn't been verified through a true pre-approval process. Okay, so now we got that covered. That's probably the most important message from today's training, right? Because you don't know how many times we get emails from MLOs. Do we really have to do all of this work to pre-approve the customer? And my reply is, why would you want to issue an invalid document that could come back and bite you, like I just mentioned, when you get the actual data and documentation and now it is not as it was represented? Happens all the time. You don't want to fall into that trap, because that's really going to be a bad time for everybody involved in the transaction. Now, be aware that pre-approvals are usually required by listing agents as part of the offer documents presented. Typically, if a pre-approval is not presented with the offer is going to go to the bottom of the stack, or it may not even be reviewed. Now, there are some rare cases out there where I do actually see listing agents accept offers where they don't even have a pre-approval from the borrower, right? So that's far and few between. I feel bad for those listing agents and for the owners of those properties, but do be aware that typically if you don't provide a true pre-approval with the offer documents, the offer is not going to be reviewed. And buyer agents typically require pre-approvals from their buyers before showing them properties. Typically they do. Now there's a few out there again that don't. Those are the ones that end up wasting a lot of gas and have a lot of contracts that do not close. Now, please be aware that pre-approvals have multiple benefits, right? Pre-approvals promote a targeted approach in the borrower's actual price range, right? They're not going to be looking at properties they don't qualify for, either because they don't have enough money or they don't have enough income, right? They're going to be more focused and efficient in the process, right? And you are going to be the process itself is going to be more focused and efficient, resulting in higher success and satisfaction for all involved parties, right? The listing agent, the buyer's agent, which are going to be your future referral partners or current referral partners, and the buyer/borrower, which is also going to be a referral partner once their deal closes and they're happy. And best of all for the MLOs out there, right? You're going to have a higher closing rate, a steady stream of referrals, and a sustainable MLO career. It doesn't take too many canceled deals for you to be discouraged, especially if you're new to the business and want to exit the business because you're just not making any money, right? Well, obviously, one way to avoid this from happening is to make sure that your deals close. And that's why you definitely want to make sure that everybody is properly pre-approved. So let's get into the different pre-approvals that we can provide. We were basically going to have two channels that we're looking at here. One would be agency, which is going to be your conventional loans, your FHA, VA, and USDA. Those are always full doc. And the other channel is going to be the non-QM channel, the non-agency channel. So let's first talk about what is required for an agency pre-approval. Now, like I mentioned, they're always full doc, and they, the first route is going to be automated underwriting, right? Now there is manual underwriting, which I'll get into further down the slide, but automated underwriting, in other words, DU or LP, is a must to issue a pre-approval letter. You must have an approve eligible from DU, and actually, if we're a lender, it's DO, but everybody knows the DU phrase, so we use DU. DU is actually for brokers. But you need to get an approve eligible, or you need to get an accept if it's LP, which is Freddie Mac. So either approve eligible for Fannie Mae or accept for Freddie Mac. You need that finding in order to issue the pre-approval letter. If you get anything other than that, and I've actually seen this, do not issue the pre-approval letter, right? If you need to go to manual underwriting, there is an option to submit a loan for a manual underwrite for a TBD file, right? If it's a purchase pre-approval, they don't have a property yet, it's TBD. They have processes at most investors and lenders out there for you to be able to submit that file as a manual TBD submission, so that an underwriter can actually review the full file and issue their underwriting decision subject to actually getting the property, right? But only then, if you receive that manual underwrite approval for that TBD submission, would you be able to issue the pre-approval letter for a file that did not receive approve eligible for a Fannie loan or except for a Freddie Mac loan, regardless of if you're talking about FHA, USDA, VA, or conventional, all the same requirement. Now, there are certain credit score requirements, credit score and trade line requirements. Do be aware that when you use an automated underwriting is going to determine the maximums for DTI and the maximum or minimums for the credit score. Now, keep in mind, there are some maximum thresholds, like 49.99 is the maximum for conventional total debt, and 56.9% is the maximum DTI for FHA. USDA and VA are a little trickier. So those are going to be determined by AUS, especially VA, which also takes into consideration residual income, right? If the borrower meets the residual income requirement or exceeds it also by a certain amount, you're more apt to get a automated underwriting approval with DTIs even as high as 60 to 65%. So don't be discouraged when you see that high DTI on a VA loan until you actually submit it to automated underwriting and see what the findings provide. I've gotten approvals at 63% DTI on a VA loan, and I've gotten an approval to close that file. So just got to be aware. Now, for conventional loans, do be aware that the matrix has 620 as the minimum credit score. So if you're below 620, you're not going to get an approval, regardless of DTI and LTV. Also be aware of certain items that are going to affect the outcome of your automated underwriting, for like disputed accounts, for example. That's a really big one. You got to look at the credit reports, note the disputed accounts that are on there, and run automated when you run automated underwriting. Because for a conventional loan, for example, it's going to tell you something to the effect of we ran, you got your automated underwriting approval. However, DU noticed that there was some disputed accounts, and then they're going to give you the following message. DU was able to take the disputed accounts into consideration in the analysis, and no further action is needed from you, which means your automated underwriting approval is valid. Or you could get the message, DU was not able to take those accounts into consideration, maybe because the balance is not there or for whatever reason, and then it's going to tell you you need to downgrade your approval to a manual underwrite, which I'll get into manual underwrite on conventional loans in a minute. For FHA, for example, it's the verbiage is already part of the findings. It's going to say if you have any disputed accounts where the total of the disputed accounts is $1,000 or over. So in other words, you have 4 disputed accounts, let's say 250, 250, 250, and 300. You're over the $1,000 limit, is going to tell you you got to downgrade your approval to a manual underwrite. Unless, for example, the borrower then undisputes one of those accounts. Now you're under $1,000 in the total limit of disputed accounts, and then your automated underwriting approval would still be valid. But do remember that when the customer is undisputed an account, you're going to have to do a rapid rescore to get that information pushed to the credit bureaus quickly so you can close this deal, because simply doing a credit supplement to remove it from the report will not satisfy, because when automated underwriting is run, it's going to pick up the disputed accounts again. The only way to get the accounts off is to do a rapid rescore once the customer provides the information that the account has been taken out of dispute status, and then your DU will be valid. I recently had to do that for a loan. Borrower had $1,400 in disputed accounts. One of them was for $500. He paid that one off, and we updated the credit report via rapid rescore, and we were able to run our new DU and maintain the validity of our automated underwriting approval. So do be aware how disputed accounts may affect your pre-approval. It's not the first time that an MLO has missed that very important detail, provided a pre-approval because they saw they approved eligible at the top of the DU sheet. They got super happy. They didn't read into the conditions on the automated approval findings. And then the customer gets under contract. Everybody's full speed ahead. I love it. Beautiful. And then the file goes to underwriting, and then the underwriter obviously picked up on it and sends it back and says, hey, this is manual underwrite, and your borrower's at, let's say if it's FHA, your borrower's at 54% DTI. That exceeds the maximum allowable for manual underwrite on FHA, which is normally 43% on the total debt, unless you have compensating factors. Or on a conventional manual underwrite, which actually we do have sources that can, we can provide manual underwrite, let's put it that way, for a conventional, but the maximum DTI for the manual underwrite and the conventional is 36%. And let's say our borrower was at 41, which was beautiful for our DU, but not for a manual underwrite. And now all of a sudden the deal is dead. Nothing can be done unless the disputed accounts are brought out of dispute, which can raise other issues when you undispute an account. You can check this out in the credit simulations. When you click to remove the dispute on an account, it may affect the credit score. And when it does affect it, it usually affects it down, because now all of a sudden you're opening the credit report to the effect of that usually delinquent account. And now the score may drop 20, 30, 40, 50 points when removing the dispute from that account. So do be aware how disputed accounts may affect the validity of your DU or LP findings, and totally invalidate your pre-approval. And then collections and charge-offs is another important thing to take into consideration. When it's a conventional loan, the system is going to let you know if those collections or charge-offs need to be paid or not. If it's FHA, they're going to tell you if you don't have a payment for those collections, a payment plan in place for those collections, you got to put 5% of the balance as a payment, and then see if the borrower still qualifies. So do be aware, collections and charge-offs do have to be addressed when you're setting up the file to run an accurate DU or LP request. So again, I already mentioned maximum DTI is determined by automated underwriting when that's what's being used. And then reserves is also determined by automated underwriting. Typically, FHA loans don't require reserves, but when we have lower credit score borrowers, you may not get an approval unless the system detects some reserves. Same thing with conventional loans and all the other loan types for agency. It's all risk-based. The lower the risk inherent in the file, the less you're going to be asked for reserves. If there is more risk inherent in the file, the system may not approve it unless it notes that there are some reserves. And if it's a second home or an investment property, you're also going to be asked for reserves on the conventional loans. I think on an investment property, I think it may ask you for at least 6 months reserves if it's an investment property on a conventional loan. And remember, these assets need to be sourced and seasoned. Any large deposits above and beyond a certain amount. And the findings will let you know, based on the income of the borrower, monthly income, any deposit over X dollar amount, you're going to have to source it. If not, and this is a pre-approval, you may want to explain that to your borrower, and they may want to wait till those large deposits are already seasoned, where they're not going to come up. And also be aware, when you do get that approval, it may ask you for only 1 month bank statement instead of 2 months. So at that point, they would only have to wait for that large deposit to not show on the current bank statement that's going to be provided, and then you would be good to go, where your money would already be seasoned and you would not have to worry about sourcing it, which can be an issue for some people that have cash at home. They're going to deposit the cash. That's fine. Tell them to deposit it now and then wait for it to season in the account so they could be ready to purchase. And any gifts, if there's going to be gifts, make sure that you explain to them the proper way to get the gifts into the account so that we don't have any problems. In other words, we don't want the gift to be cash. Always prefer the gift to be either a check from the donor, or even more preferable, a wire transfer from the donor. Then you definitely want to confirm the seasoning on title of the property. If it's a refi, seasoning on title is essential. FHA requires at least 12 months seasoning on title for a cash out refi. Conventional as well. If you're going to use the current appraised value instead of the purchase price, you're going to need 12 months on title as well. And then non-QM, you got to look at the guidelines to see for the source, for the investor or lender where the loan is being submitted to underwrite for, to make sure that the seasoning requirements are met by the borrower. If it's a cash out, typically if it's a rate and term, most of the time it's not going to be an issue. You'll be able to use the appraised value instead of the purchase price. However, there are some options out there that are 12 months on both rate and term and cash out. So don't assume anything is across the board the same. Um, Really important also is seller seasoning on title. For example, FHA has the 90-day rule that if a seller is reselling a property, um, it cannot be put on the contract until the 91st day that the seller has owned the property. So FHA deal, if they bought the property 45 days ago and now you got that contract, guess what? That's going to be invalidated as soon as it gets to underwriting. So you got to ask those kind of questions, let the buyers/borrowers know that could be an issue on an FHA deal. And then on your non-QM deal, equally as important, seller on title, because if the seller has been on title less than 12 months, that's considered a flip. And then there are going to be additional appraisal requirements for a flip. And remember, that's the seller on title. We're not talking borrower on title, we're talking seller. And then it's usually going to be based on what is the appreciation on the property, right? If it's above a certain amount, they're probably going to require a second appraisal or some kind of secondary valuation method like a CDA or an AVM. To be able to proceed. So do be aware, seller seasoning on title is just as important of a consideration as borrower seasoning on title when it's a refi. So seller seasoning on title when it's a purchase, just as important as borrower seasoning on title when it's a refi. Different reasons, but can equally affect the deal. Now, I did mention manual underwrite, right? So if AUS does not give you the approve eligible or the accept that you're looking for, then manual underwrite is the only option that we're going to have. And like I did mention, we actually do have manual underwrite possible for conventional loans. That's pretty cool, right? But do be aware, 36% is the maximum DTI for that manual underwrite on the conventional loan. And we also have manual underwrite available for FHA, VA, and USDA as well. But do be aware that there are maximum DTI. So the maximum DTI is going to be whatever is written on the matrix, right? You're going to have a standard matrix, and then you're going to have automated underwriting matrix, right? The standard matrix is the one that's more restrictive. That's what it says. I think 31 front end for FHA, 43% total debt for FHA, unless there are compensating factors. Compensating factors like reserves, no or very low payment shock, for example, and any other factor that could be a compensating factor. You know, they've been on the job 20 years, a bunch of different things that you could put in there that could allow them to go higher in the DTI for a manual underwrite. So a lot of stuff here to take into consideration on the agency pre-approval. Now, if your loan is non-QM, do be aware of the following. Non-QM loans are always manually underwritten. DU and LP are never applicable for a non-QM loan. So please do not attempt to run AUS on a DSCR loan and then reach out for assistance with the errors that you're getting because you're trying to run DU or LP on a non-QM loan of any type. You know, whether it's a full doc loan or whether it's an alt doc loan or a DSCR loan, it's never applicable. So just don't run it. It's always manually underwritten. And for the non-QM pre-approval, the MLO is the AUS. Let's put it that way. You are the automated underwriting. You're the search engine. You're the one that's going to have to complete a thorough review of the guidelines after taking into consideration all the loan parameters and the special circumstances of the situation, right? You're going to look at the guidelines of the different options that you have, and you're going to pick the best one, right? Like for example, I was helping somebody yesterday structure a pre-approval for a borrower who's looking to get under contract on a property. Actually, borrowers, father and son, looking to purchase their first investment property. Now, what are the special circumstances here? Several special circumstances. The first one is the son is a first-time home buyer, first-time investor, and lives at home rent-free, in the property owned by the dad. The dad, not a first-time buyer, but is a first-time investor. Third special circumstance, the son has an 823 credit score and the father has a 705 credit score, right? We're trying to get the deal. Now, there's a lot of things going on there that could affect this loan being properly pre-approved. So if all you do is look at the credit scores and run with it and not find out what are the effects of first-time home buyer, first-time investor going to have on this DSCR loan, and what can I actually do about the credit. So you may just realize, I got to price it out with the lowest middle score of the two borrowers, price the deal out with a 705 credit score, pick whichever is the lowest rates out there without taking into consideration what is the impact of the fact that we have a first-time buyer, first-time investor, one borrower, and the other borrower is a first-time investor, right? That could affect a lot of things, including your LTV. But furthermore, if you don't look deep into the guidelines and take advantage of the opportunity, you may not even get an opportunity then to be the MLO, because you may provide the quote based on a 705 credit instead of, after I delved deep into the guidelines as I was doing the structure meeting yesterday with the MLO, and letting the MLO know that we can actually use the higher of the two credit scores for this DSCR loan, and we can actually use the father's mortgage payment history as the housing expense. It doesn't, as a housing history, housing payment experience, right? It doesn't matter that the son is a first-time investor and a first-time buyer and lives rent-free, because the father, who's also in the deal, has the housing payment history. And we were able to use the higher of the two scores on a DSCR loan, which doesn't take into consideration personal income of the borrower, only the income generated by the property, the gross rent. So with that being said, we were able to provide a quote based on an 823 credit score instead of a 705 credit score, and we're able to provide a rate almost 0.75% lower at the same LTV, and that got us the deal, right? Borrower was super excited with the quote that we provided. We have great rates at the mortgage calculator regardless, but if you get an 823 score at an 80%, you're going to get a much better rate than at a 705 score, because there's just going to be more options. A lot of options don't open up unless you have at least a 720. So which happened to be the option that allowed first-time buyer, first-time investor, no housing payment history, as long as the other borrower has a housing payment history, was one that required at least a 720 score. So due to the fact that they let us use the higher score, we were able to provide the option and we got the deal, right? But if you provide the wrong one, you may not get the deal. And if you get the deal, it may present other issues. And again, if you provide the option that doesn't allow the first-time investor and first-time buyer, underwriting is going to knock you down, and then you're going to have to go back to your borrower and explain why now they're at 75% LTV instead of 80, and that's going to kill the deal. And like every other option, even like agency, should I say, you still have to worry about disputed accounts, collections and charge-offs, and credit events. However, in this case, you got to go into the guideline that's specific for the option chosen to see what they allow. In some cases, they allow you to leave the disputed accounts alone. Other times, they tell you got to bring the balance down to 250 and you can keep it disputed. And others may say, no, we don't allow any disputed accounts at all, right? So again, that's why as you're reviewing all the options, you got to note that guidelines are not homogeneous. You can't make across the board assumptions. You have to really review each guideline to find the best one applicable to your borrower's situation. So in some cases, they allow them to remain unpaid as long as the borrower has enough reserves to cover if you had to pay him, and then you add 5% of the amount to the payment, right, for DTI loans. For DSCR loans, they're a little bit stricter. They usually require them to be paid. And then credit events the same. All of this is going to depend on the program you select. If it's a program that requires A+ credit, if it allows A, B, C, or D, that's all going to determine if it's applicable. And that's where you have to probe the guidelines deeply. And then, of course, when you're discussing the deal with your borrower, the same scenario when you're talking about income, right? Except here we have the options of if they're self-employed. You know, we can go bank statement, we can go P&L. If it's an investment property, we can even do DSCR. We have the no income CDFI option for primary and second homes. I mean, there's a whole plethora of products out there related to different income types. So just be aware what they are, gather as much information as possible, and then review all the guidelines to make sure that you have the best option for your borrower. And then with assets, it's the same: sourcing, seasoning, gifts, reserves. You got to review the guidelines to see what they say, right? Especially with the gifts. Some cases we have options, for example, DSCR, that allow 100% of the transaction cash to close to come from a gift, except for reserves. Reserves then may have to be covered by the borrower's own funds. We have other options that say, yeah, as long as they come up with at least 5% of their own money, they can use the gift. And other options that say as long as they come up with 10% of their own money, we can use the gift. So again, you got to review the guidelines. And then with property, I already mentioned the borrower or seller seasoning on title and how that can affect the deal. Remember also that DSCR pre-approvals allow borrowers to compete with cash buyers. So always when you're sending out that pre-approval letter for your DSCR borrower, the realtors love it, because if you reach out to the listing agent before sending the pre-approval out and you're asking them to provide you, introduce yourself, to provide you with some rental estimates, and let them know that you'll be sending, that you're pre-approving the borrower. You're already building rapport with that listing agent in case there's multiple offers. And rest assured that when they provide you the rental estimate, right, they're going to feel pretty proud and secure about their property. And when they receive your DSCR pre-approval, they're going to know that's almost as good as a cash deal. And your DSCR buyer is usually going to be offering more than the cash buyer. And they'll probably go with your DSCR loan financed offer instead of the cash buyer, because they know the solidity of your pre-approval, especially if you already reach out to them, asking them for estimates on the rental for the property. That this is all critical to landing the deal. And last but not least, our borrower and real estate agent duties in the pre-approval process, right? This is very important. Borrower duties, I mean, this is not an all-inclusive list, but these are real important bullet points here to consider. Please, the borrower, we want to make sure that they complete the loan application as thoroughly as possible, and that they avoid, and then we look for, undisclosed debts or liabilities, undisclosed properties, even if they're free and clear. They got to qualify for the taxes and insurance on those properties. Undisclosed business losses that may show up once we get the actual tax return. Borrowers need to provide the requested documents on a timely basis, and borrowers can never open any new accounts or increase the balances on their credit cards, because if a new credit report has to be obtained in the process, due to maybe it's expiring and it was a couple of months old. Now all of a sudden you get a report with a 20 or 30 point lower score. It's going to blow the deal. And real estate agents also have duties, right? The real estate agent has to communicate and coordinate with the borrower and with the MLO. They're usually the go-between. We want to make sure that the borrower submits a competitive offer, right? Competitive to get the deal, but also remember this property has to appraise at the end, or else we may have some issues. The real estate is going to be the focal point in the contract negotiation and in any request for seller contribution. Make sure they're aware if there is a need for that, right? That you've communicated with the agent the need for seller credit in order for the borrower to be able to qualify. The realtor is also going to have to monitor the need for the finance contingency and closing date extension. So you also need to be aware of that, right? So when you get that contract, the contract's going to have like a loan approval period or the financing contingency period, whatever you want to call it, which is the period during which the borrower has to qualify for the loan, or a denial letter has to be provided during that financing contingency period so that the borrower can get their deposit returned. It's not just the closing date. Now, the closing date is another one, so you definitely want to extend the closing date so the borrower is not in default of the contract. But extending the closing date does not automatically extend the financing contingency period. So any extensions on the contract for time would actually have to include, if the borrower is not yet approved, an extension of the financing contingency period and an extension of the closing date to ensure that the borrower doesn't lose their deposit if the deal doesn't get approved. Now, real estate agents also have to understand that the pre-approval is not a loan commitment, right? It's subject to final review of all documentation provided, subject to a title commitment, subject to appraised value, all those good stuff. And we also want real estate agents to avoid offers without a financing contingency. I mean, if it's a cash deal or the borrower has the cash to back it up, if the loan doesn't get approved, that's great. But they cannot assume that they can present an offer without a financing contingency just because the borrower is pre-approved, no matter how thorough the pre-approval is, right? Try to have them avoid offers that do not include a financing contingency if financing is being used. So that's all the info I have there. So let's get into some of the questions that we have here. So we have one of the MLOs asking here, or one of our actually participants here asking, do you have a trusted credit repair company for clients who need help with their credit? We don't like to recommend any credit repair companies, actually. If the borrower wants to use one, find one on their own, that's great. That's up to them if they think it's going to help. But we definitely don't want to get into the habit of recommending anybody and having anybody prepay for any of those services. And we definitely would not want them to contract to work with a company that's going to ask them to prepay a whole lot of upfront money, because then what's going to happen is if they do not get any positive results from that credit repair company, they're going to be mad at the credit repair company, and they're also going to be mad at you if you recommended that they use that company. So now not only are they, not going to get approved, but they're probably not going to use you for any future deals that they may get approved for, and they're not going to recommend you to anybody. So you're never going to get any referrals from them. Everything's going to be blown simply because they gave a credit repair company $300, $400, $500, and the people ditched them, didn't respond to their calls, or did nothing for them. They look at it as, I just blew my $500 or $1,000 there, and it's your fault because you recommended them. So as far as if you want to learn more about reading credit reports, I mean, we have several trainings that you can access on analyzing the credit report and a rapid rescore. And I'll probably be repeating that training sometime in the near future because it's a very good one, because you definitely need to know that even if you don't have the credit report, you need to know what are the factors that affect the credit score. Because when you're talking with the customer and you're asking them, okay, what's your minimum payment on your credit cards? How many credit cards do you have? Okay, for credit card number 1, what's the balance? What's the limit? Number 2, what's the balance? What's the limit? Number 3, what's the balance? What's the limit? And then once you get your data down and you look and you see that all these cards are maxed out, you're going to be able to talk to the customer how that affects their credit score, and how possibly paying down the balances is definitely going to assist with the credit score, and how a rapid rescore could push the balance information to the credit bureaus within 3 to 5 days, and you would have a new credit report with new scores. Now, obviously, you'd want to at some point have them apply so you could pull the credit, or the system pulls your credit, and then we have credit simulation possibility included in our credit report at no additional fee. So you could run either a target score simulation where you put a target score and the system tells you what needs to be done, or you do the smart score simulation where you change balances, run the simulation, and the system lets you know what the balance is going to be. That's a great tool to build credibility, build rapport, and make sure you get the deal. So let me see any other questions here. So I guess I'm asked here, is this, the pre-approval, the process to use if the borrower just wants to know how much home they may qualify for? I mean, having the conversation with them, again, would be the initial pre-qualification phone call, where once they provide information, depending how good of a note taker you are and how good you are at analyzing that information, you could tell them how much they may qualify for, but definitely stressing that the only thing that's really acceptable and valid is to get properly pre-approved based on the processes that I've already shown here for an agency loan or for a non-QM loan. That's the only true pre-approval. Everything else is just like a what if, but it's nothing that they could base something on now. They may say, yeah, I know I'm really not ready, so I don't want to run my credit right now. But I'm going to start saving up money, this and that. And when I'm a little bit closer to the target, then we could do the actual pre-approval where you're going to pull my credit. That I can totally understand, but you should never substitute the pre-approval, or you should never substitute the pre-qualification for a pre-approval. They're not the same thing. You would never give somebody a pre-qualification letter, or never give them a pre-approval letter based on a pre-qualification phone call. You're just setting yourself up to fail and for a big disaster. And the comment was, used to be that the breadwinner was the middle score. Well, I think what this person actually meant was that, and this is actually valid for the non-QM option that allows using to hire the 2 middle scores. And this is for non-QM, not for agency. For non-QM, and the option that does allow it is going to be the primary wage earner is whose middle score you would use, and not necessarily the higher of the 2. Another question we have here is no money for credit up front. I'm not exactly sure what that means, but in our system, the borrower does not pay for the credit report up front. We do not ask the borrower for their credit card information or ask them to give us money for the credit pull. Our system pulls the credit as soon as the loan application is submitted, assuming that the information is valid. So security, date of birth, address, all that kind of stuff that doesn't get rejected by the credit reporting agency, we will get our credit report without charging the borrower upfront. So waiting to see if we got any any additional questions? Had a few good questions today. Again, this is probably one of my favorite trainings to do, because this is the one that I know is going to allow MLOs to differentiate themselves from the masses out there of application takers, right? You want to be a loan consultant. You want to differentiate yourself from the masses, right? And the way to do it is to be the consummate professional. And people pick up on that, right? People pick up when you're going above and beyond the call of duty, and they will want to use your services, because right now it's such a competitive market out there to try to get a property. So buyers, for example, want to make sure they employ the best people, and to have the best people on their team, the best realtor and the best loan officer, those that are going to find them the property, be able to negotiate and land the contract. And that's what it depends on, if it's a fly-by-night realtor or a fly-by-night loan officer. When that listing agent gets the offer, they're going to realize this is looks like a sketchy pre-approval, especially they call up the MLO and they can't confirm that they actually verified any of the data. That offer is going to basically be discarded. I got another question here, which I did answer. I did speak about this in the presentation, but I'll gladly answer it. When you have a pre-approval for an FHA loan, do you still run DU, DO, AUS, LP? Yes, always. For every pre-approval that is an agency loan, in other words, conventional, FHA, VA, and USDA, those are agency loans, called agency loans because of Fannie Mae, Freddie Mac, and Ginnie Mae, which are the agencies that buy those loans in the secondary market. You would always require AUS on those loans, and if you don't get an AUS approval, either approve eligible or accept, manual underwrite is an option, but then you have different DTIs requirement on those. So I'll give it a minute, see if we get any more questions. Hopefully I did a very thorough job. You'll appreciate this. So I don't see any additional questions. So I do thank all of you for being on today's training, and look forward to having you on next Thursday's training. Have a great afternoon, and looking forward to helping you pre-approve your buyers or pre-approve yourself if you're not an MLO. Have a great day.